Imagine waking up one day and realizing your job didn't just get outsourced overseas. It's being restructured by software that works nonstop and costs almost nothing to run. In 2025, AI and automation aren't just replacing repetitive tasks, they're reshaping roles many thought were safe. Some positions in law, design, and coding are already being reduced as AI tools take over routine drafting, design iterations, and code generation. Industry reports show adoption in these fields climbing far faster than expected. I'll show you the simple model that explains where real income will come from by 2040 and the first steps to start building it now. The economic model you didn't learn in school. Most people never hear this laid out clearly, but every dollar you've ever earned, whether from your first summer job or your most recent paycheck, comes from only one of three sources: wages, money you receive for trading your time, skills, and presence for work; transfers, money provided by governments to individuals or households through programs such as Social Security, unemployment benefits, or subsidies; property income, money generated by assets you own, like stocks, real estate, intellectual property, or data rights. That's it. Not four, not a dozen, just three primary streams. Understanding these categories is the key to seeing why so many households feel less secure and why the imbalance between them is widening. The first stream, wages, is the one you probably know best. It's the paycheck you get for showing up and doing the work your employer requires. Hours for money, under terms the employer sets. This is how the majority of households have historically earned most of their income, what economists call market income. That reliance made sense for decades, but the stability of wage income is now under pressure. AI systems, automation, and globalized competition are eroding demand for human labor in many sectors. Some jobs are disappearing entirely, others remain but pay less or demand more for the same wage. And while certain roles, like software developers, are projected to grow in the near term, others such as paralegals or clerical staff are facing steep automation headwinds. The shifts aren't uniform, but they are accelerating. The second stream, transfers, sounds simple but works differently. These are payments or benefits made by the state: pensions, child allowances, disability payments, unemployment insurance, or emergency relief funds. You don't clock in to earn them, they arrive through policy decisions, funded by taxes and borrowing. Transfers can be essential for cushioning shocks and keeping people afloat during job loss or crises, but they cannot scale indefinitely as a wholesale substitute for lost wages. Economic data and budget analyses show that, when too many households depend primarily on transfers for income, the fiscal and political pressure to limit or reform them grows quickly. The third stream is property income. In economic terms, property means productive assets, resources that generate value whether or not you're actively working. This can include ownership stakes in companies, land, rental property, patents, media rights, or even data streams that someone else pays to use. The income it generates, dividends, rent, royalties, profit shares, flows to you because you own the asset, not because you worked a set number of hours in a given week. This is fundamentally different from wages, because the limit on your earnings isn't imposed by the number of hours you have in a day. Right now, most households in developed economies still rely primarily on wages for their income, with transfers making up a smaller share and property income contributing very little unless investments or business ownership are already in place. That balance worked as long as wages were widely available and kept pace with the cost of living. But today, the signs of strain are everywhere. Companies are not just trimming payrolls, they're reframing whole work processes to remove human labor, where machines and algorithms can do the job better, cheaper, and continuously. In many middle and high-skill professions, technology is not nibbling at the edges. It is being embedded into the workflow in ways that cut demand for human labor sharply. Traditional advice when wages are under pressure: return to school, retrain, move into a more resilient field, still works for some. But for many, the fields they're training for are being reshaped under their feet. Completing a degree doesn't guarantee security if the target job is one that software can take over within a few budget cycles. The danger isn't that wages disappear in one dramatic crash. It's that the spread between what human work earns and what assets can produce keeps widening. If your income is tied only to wages in declining or unstable markets, you're in a fragile position. Transfers, while invaluable in emergencies, face hard limits. Expanding them to replace mass wage losses would require sustained political will, high taxation, or borrowing at levels that most governments cannot or will not sustain over long periods. That's why simply assuming the safety net will catch me is a high-risk bet. Property income, by contrast, operates on a different set of constraints. Once you have an asset that produces economic value, it can generate returns with minimal incremental input from you. The owner of a rental building earns from it whether or not they work elsewhere. The holder of profitable shares gets dividends regardless of their daily routine. A musician with a hit song or a developer with licensed code sees royalties come in as long as others keep using the work. Building assets takes capital, skill, or both, and in many cases there's real risk involved. But the structural advantage is that asset-generated income can scale without being bound to your personal labor capacity. And in an economy where automation is absorbing more of the direct work, the ownership of productive assets is how the value from that work is captured. Without ownership, you remain on the consumption end of the chain, paying for the use of someone else's assets, not earning from them. We've already reached a point where working more hours doesn't always mean bigger annual earnings. For many gig workers, contract professionals, and even salaried employees, longer hours simply dilute effective pay rates or lead to burnout without real financial gains. Meanwhile, those whose income includes a healthy share of property returns can see growth even if they work fewer hours. That divergence is visible now in wealth and income data, and it's one reason inequality tends to widen during technological shifts. So when you step back and map your own income streams against this model, wages, transfers, property, you can see exactly where you're vulnerable. If nearly all your earnings depend on wages, you're relying on the stream under the most sustained pressure from automation and restructuring. If transfers make up the second tier, recognize they are designed for support, not as a universal replacement for the job market. Without some property-derived income in the mix, you have little insulation from either disruption. This model isn't theory, it's the framing through which policymakers, think tanks, and investment strategists are already viewing the next 20 years. It explains much of the tension people are feeling without always knowing why. And in the coming years, the most jarring changes may not be in low-wage, repetitive work, but in sectors many thought would be safe from technology's reach. AI didn't just take the boring jobs. In early 2025, several major law firms began publicly incorporating generative AI tools into the drafting and review of routine legal documents. These weren't fringe experiments, they were embedded in daily workflows, with vendors and in-house pilots handling tasks that once required teams of junior staff. While such tools primarily target standardized contracts, discovery documents, and initial case research, their adoption is already reshaping staffing needs. According to U.S. Bureau of Labor Statistics analyses, paralegals and legal assistants are more exposed to this shift than fully qualified lawyers, but the result in both cases is the same: fewer entry-level opportunities and altered career paths. This is a notable break from the way office technology used to roll out. For years, automation was described as something that chipped away at repetitive, low-skill tasks, roles on the factory floor, basic data entry, or routine call center work. High-wage, knowledge-intensive jobs were implicitly treated as safe havens. The assumption was that years of education, refined judgment, and professional networks would form a natural barrier against automation. That assumption no longer holds. Modern AI systems are handling work once considered immune, precise, language-rich, and legally sensitive, without the prolonged training periods humans require. What sets this phase apart is that machine capability now extends into complex cognitive terrain, parsing a client's brief, identifying relevant precedents, and generating a structured agreement is not rote work. In parallel, medical imaging analysis offers a similar case. Some hospital systems now deploy AI to conduct initial screenings of radiology scans before a human specialist reviews them. The technology can flag anomalies in milliseconds, and performance in certain detection tasks rivals, and in some cases surpasses, the average human benchmark. These examples show that it isn't just mechanical repeatability AI can master, it's also pattern recognition, inference, and decision-making at scale. Yet the labor market impacts aren't uniform. BLS case studies and recent industry reports note that within computer occupations, some engineering and systems roles are projected to grow even as narrow parts of the workflow are automated. In law, the augmentation of high-end practice with AI may expand certain advisory or strategic work, even as document-heavy segments shrink. In other words, the disruption hits unevenly. Some tasks disappear, others evolve, and new ones may emerge alongside the tools. Still, the economics for employers can make the replacement decision straightforward in targeted areas. Removing one $200,000 a year role and substituting a $20,000 a year system subscription generates immediate budget impact. Even in software development, long considered a technology-proof frontier, AI-assisted platforms now allow a single senior engineer to orchestrate large code bases that previously required whole teams. For a company making that choice, it's not just about cost, it's about speed and consistency. AI systems will not fall behind on deliverables, and test cycles can be run instantaneously. This inversion, where highly compensated roles face sharper cuts than some lower-paid ones, emerges from return on investment logic. A reception desk might still have a person behind it because the savings from replacing them with a kiosk are modest relative to other opportunities, and human presence still carries perceived client value. In contrast, an AI module replacing a senior analyst's workflow can repay its integration costs within a fiscal quarter. Such calculus has begun reversing the relationship between job prestige and job security. For students and early career professionals in traditional safe careers, the consequences are immediate. The graduating law class may now meet firms that have frozen intake for junior roles precisely because AI systems handle the repetitive groundwork. In finance or design, similar hiring slowdowns reflect the front-loading of machine capability within production pipelines. For individuals, this means the return on time and money invested in acquiring those qualifications is no longer assured. Scalability amplifies these effects. Training a human to handle complex drafting or diagnostics takes years, with ongoing supervision and inevitable mistakes. Training a model consumes heavy resources only once, after which its output can be deployed anywhere an internet connection exists. When a firm integrates such a model, it can standardize that capability instantly across locations, eliminating staggered adoption patterns. Crucially, the speed of change is no longer dictated by technological hurdles, but by organizational will. In past industrial shifts, building and installing new machinery could take years. Today, an AI service can be integrated via an API call or a cloud subscription, slotting into an existing digital workflow overnight. Once the decision is made, there's minimal physical barrier to replacing the relevant human tasks. Workers often find out only when those tasks are no longer assigned to them. The safe zone between replaceable and irreplaceable work is therefore unstable. Industries that once moved gradually, adding assistive tools to support human experts, are now bypassing incremental stages and moving straight to partial or full substitution for specific decision-making functions. This is not only stripping out income for affected individuals, it's also eroding professional identity in fields where roles were tied to years of training and status. None of this means all high-wage jobs are vanishing overnight. For many, AI is a force multiplier rather than a direct substitute. A legal team might retain more senior counsel while cutting the number of junior attorneys or support staff. In medicine, AI may handle initial screenings, but elevate the demand for specialists capable of interpreting gray area results and guiding treatment. And while clerical roles in finance may shrink, demand for oversight and regulatory strategy could expand. McKinsey and BLS research both stress that across sectors, AI's impact is more a reallocation of tasks within jobs than a binary of destruction versus preservation. However, the net effect on the current workforce is a rapid reshuffling of where income opportunities lie. Those in roles that can be compacted into a predictable, programmable task set are more at risk, regardless of prior prestige. And those shifts are unfolding in cycles measured in quarters, not decades. For individuals whose earnings depend heavily on one such role, the pace allows little time to pivot. That's why 2025 has already delivered sharper shocks than most automation trendlines predicted. Change is not working its way up the career ladder from low to high. It is landing wherever a cost-benefit calculation favors machines over people, irrespective of skill level. As the field evidence shows, some roles will adapt and persist, others will contract or fragment into narrower specialties, and some will disappear entirely from human hands. Understanding this pattern is essential because it frames the challenge that's now emerging. For the first time, a technology can be aimed at high-value, judgment-based work and scaled across industries almost instantly. The question is no longer whether certain kinds of labor will be touched, but how quickly each sector will decide to let go of its human share. And that shift has no real parallel in earlier periods of technological change. Why this time isn't like the Industrial Revolution. You've probably heard the familiar reassurance. We've had disruptive technologies before, and we adapted. People point to the spinning jenny in the 1700s, the steam engine, the assembly line, personal computers. All of them overturned ways of working, removed certain jobs, and yet new opportunities emerged. By that reasoning, AI should just be the next chapter in a long cycle. But in 2025, the differences are visible enough to question that logic. The surface parallels to the Industrial Revolution quickly break down once you look at the mechanics underneath. The first distinction is speed and scale. When the Industrial Revolution brought machines into manufacturing, diffusion was tied to the pace of building and shipping physical hardware. Years could pass before a single innovation spread beyond a city, and decades before it became common across industries. BLS historical reviews note that these rollouts were often measured in generations. McKinsey's analysis of enterprise AI adoption shows a radically different curve today. Once an AI model is trained, it can be duplicated in seconds and deployed globally through existing digital infrastructure. There is no need for material inputs, shipping, or construction, so an improvement that might once have taken decades to reach mass use can now be in offices, factories, and homes worldwide almost immediately. The second difference is cost per task. A steam-powered loom still consumed fuel and required operators. Every extra yard of cloth came with measurable resource use. With AI, the cost of generating the next legal draft, marketing plan, or data analysis approaches zero. The expensive part is training or licensing the system. After that, running another task incurs almost no additional expense. If a company can replace a high-salaried role with a tool whose marginal cost per output is close to nothing, the incentive to switch is overwhelming. Return on investment is almost immediate, with little reason to phase changes in slowly. The third distinction is autonomy. Past technologies, no matter how advanced for their time, depended on humans to set them up, operate them, and make judgment calls. Even automated machinery needed people to approve designs, correct errors, or adapt to new circumstances. Current AI systems can take on tasks they weren't explicitly programmed for, adjust outputs based on feedback, and detect patterns no one told them to look for. This isn't just augmenting human work, it is producing new capabilities without being taught in the traditional sense, and applying them at scale. Removing the human training bottleneck matters. In professions like medicine or law, readiness to take on critical work comes only after years of study and supervised practice. Training enough people to fill demand is slow and costly. AI removes that delay entirely. Once a capability is established, it can be deployed anywhere overnight at expert-level performance. This makes the displacement of certain functions untethered from the rate at which humans can retrain into new roles. You can already see this across industries in 2025. In agriculture, AI systems monitor soil health, predict optimal planting windows, and guide harvesting strategies, replacing decisions once made by farmers with decades of intuition. In finance, AI-led auditing platforms review millions of transactions in seconds, flagging irregularities without downtime. These shifts don't just automate routine work, they insert machine judgment where, until recently, human judgment was the only option. One of the defining features of the Industrial Revolution was that as old roles diminished, entirely new industries could absorb displaced workers. The job loss in one area was, to a degree, offset by job creation in another, and the transition was gradual enough for many to move across. In contrast, AI's expansion cuts through multiple sectors quickly. The new roles it creates often involve managing or fine-tuning AI, and those too can be absorbed by the AI itself over time. This shortens the window for humans to make the jump from shrinking fields to growing ones. Geography and infrastructure also used to slow disruption. A new machine might alter local job markets, but it could take years before it reached other regions, particularly in economies without industrial infrastructure. AI tools, once developed, can be used anywhere with internet access. They are not tied to a location or shipping schedule, compressing the upheaval into much shorter timeframes. This is why McKinsey underscores that enterprise deployment is accelerating workplace impacts far faster than earlier technology waves managed. Another underappreciated shift is the nature of the work being replaced. When machines took over physical labor, humans still dominated conceptual, creative, and strategic tasks. Today, AI is setting marketing priorities, writing design briefs, analyzing business data, and making operational recommendations without human initiation. This severs the link between human decision-making and economic output in a way previous technology never could. Pharmaceutical research offers a clear case study. Traditionally, new drug development involved years of lab work and large research teams. AI-driven discovery platforms now simulate molecular interactions, shortlist promising compounds, and prepare candidates for preclinical stages in a matter of weeks. Once this process is automated, each additional project follows instantly, reducing the need for entire early-phase teams and the training infrastructures that supplied them. Historically, these kinds of technological impacts on jobs often took longer to fully materialize than early predictions suggested. BLS reviews remind us that even disruptive tools like mechanized farming or personal computing reshaped work over years, not months. That's important context. While AI's capability development and deployment pace are unusually fast, and its reach is unusually broad, there's still uncertainty about exact timelines. Not every forecasted change arrives on schedule, even when the trajectory is clear. Where the research does align is on the near term. Enterprise adoption of AI is already accelerating changes to workflows and roles in ways that matter now, irrespective of longer-term AGI projections. This combination, instant replication, negligible cost per additional task, and adaptive learning, transforms the economics of labor. Previous machines amplified human effort. Today's AI can effectively substitute for segments of that effort altogether. References to the Industrial Revolution can obscure more than they clarify, because that was a disruption with people still at the center of the value chain. AI's center of gravity is machine-based, and it moves forward without needing to wait for human capacity to catch up. The compression of change into shorter cycles is what makes the distinction felt so acutely. In the past, transitions often allowed time for generational turnover to absorb shocks, whether through education reform, migration, or gradual sector shifts. Workers could at least see the contours of the next opportunity before the old one collapsed. Now, for some roles, market contraction begins before most people even realize the role is under threat. That acceleration has measurable impacts beyond abstract job descriptions. It is beginning to show up in pay structures, hiring trends, and the distribution of income between human labor and other sources. The effects are not running on a distant horizon. They are already visible in parts of the economy that on paper look healthy. This is where the scale and speed of change begin to intersect with wages in ways that are hard to ignore, especially for people entering the workforce for the first time. The wage meltdown has already started. In early 2025, hiring patterns and some starting offers have softened in pockets where AI-driven efficiency reduces demand for entry-level labor. In certain tech-adjacent marketing roles, for example, initial offers are coming in below where they were a couple of years ago. It's not because the companies are struggling. In fact, many are posting strong earnings, but because they can produce much of the output without building large human teams. That's the piece that catches people off guard. Growth in the overall economy no longer guarantees growth in wages for the people contributing to that economy. Economists sometimes describe this as a decoupling, the long-term divergence between GDP growth and aggregate wage growth. Historically, those two lines moved roughly in the same direction. As economies expanded, labor's share of the gains rose alongside. IMF and OECD data show that in many advanced economies, that connection has weakened over decades, with labor's share of income trending downward. The 2025 shift reflects that ongoing structural driver. Production can rise while total human compensation stagnates or slips, because more of the value flows to capital owners or is retained as higher margins instead of being paid out in earnings. You can see evidence of this in the wage share of GDP. Imagine a chart stretching back to the mid-1970s where wages made up a solid majority of total output. Over time, that share erodes in shallow steps, interrupted by periods of stability. In 2025, the slope steepens again. The GDP line keeps rising. The wage share line dips further. It's a simple visual. The pie is growing, but the slice allocated to paychecks is thinner than before. The mechanics aren't mysterious. In earlier periods of automation, think factory robotics in the 1980s and 1990s, machines took on repetitive tasks, but human input was still necessary for judgment and coordination. That meant staff levels could fall without collapsing. Today, AI systems not only handle repetitive tasks, but also absorb parts of decision-making, drafting, analysis, and even creative iteration. Businesses can meet or exceed previous output targets with fewer total hours purchased from human workers. For employers, this changes the numbers quickly. A financial analysis firm that once needed to scale its analyst headcount alongside its workload can now run the same volume of data through AI and turn outputs around faster. The savings drop straight to the bottom line, allocated to shareholders, reinvested in capital, or banked as wider margins. Labor becomes a smaller cost component. The gains from lower reliance on human input accrue to owners of the production tools, not to the employees, whose responsibilities have been reduced or redefined downward. This is why the wage meltdown is not a distant risk. It is measurable in specific roles now. Recruiters in affected sectors report less need to post high salaries to attract candidates. With a wider candidate pool and AI doing more of the technical or repetitive work, the human contribution is narrower. In some roles, stringent experience requirements have been relaxed, not to expand opportunity, but because the scope is reduced to exception handling or client interaction. A larger pool of qualified applicants for narrower work pushes offered pay down. The pattern isn't uniform. wages in fields tied to in-person manual work or customer service may hold steady in the short term. But in high-status, white-collar domains that once set wage benchmarks, compression is more visible. BLS projections, for instance, show declining employment for occupations like word processors and typists, jobs that have been historically higher-paying clerical positions, while others, including certain engineering specialties, are expected to grow. This illustrates the uneven nature of the impact. Some areas contract while others expand, but expansion does not guarantee wage increases. The result is that a positive GDP headline doesn't guarantee improved financial security for households. Consumer spending in 2025 is sustained partly through credit use and partly through government transfers, not through broad-based wage expansion. For new graduates and young professionals, entering the labor market on a lower real starting salary compresses lifetime earning potential and narrows the paths for internal growth. Overlaying cost of living trends makes the picture starker. Housing, healthcare, and core services have continued to rise in price. Adjusted for inflation, lower entry offers mean reduced purchasing power right out of the gate, and smaller or less frequent raises amplify that gap over time. This is the wage share decline experienced at the household level, less incoming value for more outgoing cost. It's critical to note this isn't driven by recession conditions. The broader economy is growing, corporate balance sheets are strong, and yet in some corners, wages are dipping. That breaks the assumption, long embedded in career planning and public policy, that economic expansion will eventually pull wages up if you remain employed and advance. For policymakers, this sharpened decoupling raises distribution questions. If the growth dividend accrues disproportionately to capital owners and the concentration of asset ownership remains high, then income inequality widens, even in growth years. For individuals, the takeaway is more immediate. Traditional wage-work trajectories may no longer offer the same payback they once did, and relying solely on them is an increasingly fragile strategy. We're already seeing early-stage adaptations. Some new entrants to the job market are pivoting toward freelance or hybrid arrangements sooner, hoping to diversify income sources earlier in their careers. That shift isn't always a matter of preference. In some cases, it's a response to reduced starting packages and weaker prospects for upward wage movement in their chosen fields. Across sectors, the message embedded in the data is consistent. The wage portion of total returns is shrinking, while the ownership portion grows. Owners may be individuals, corporations, or funds, but what they have in common is control over productive assets. From a shareholder's viewpoint, this is efficient allocation. From a worker's viewpoint, it means less leverage in negotiations and slower wage-based mobility. Here's a practical point to keep in mind. Media coverage of a major company trimming pay for new hires isn't just gossip from a single boardroom. It's a signal to check your own exposure to shifts in how value is paid out. Those headlines aren't forecasts that every paycheck will shrink tomorrow, but they're markers in a visible trend. Where work is more easily carved up and delegated to machines, wage pressure builds quickly. Responding means thinking now about the mix of income sources you can influence, not waiting until your primary one weakens. In 2025, the unusual combination of record profits, healthy GDP figures, and downward pressure on some wages makes clear that we're dealing with a structural adjustment to how work is valued and compensated. The familiar rebound cycle, where cuts reverse and wages rise in the next expansion, is less certain when technology permanently changes how much human input is needed. And that brings us to a logical next question. If the labor-based share of income is under this kind of pressure, what other sources can realistically replace it? There is one category that has historically grown faster than wages and can continue to generate returns even when you're not actively working. Understanding how that works and how to access it is becoming less of an investment hobby and more of a survival skill. The only income source that grows without your labor. The answer lies in a category economists call property income, money earned not by selling your time, but by owning something that produces value. This can take the form of dividends from shares, rental payments from real estate, royalties from creative or patented work, or license fees from software and intellectual property. The defining trait is that these flows can continue even when you're not directly working on the activity that generates them. You could be asleep, traveling, or focusing on something else, yet the income still arrives because the underlying asset is doing the work. A simple way to picture this is a vending machine placed in a busy location. You invest in buying it, stock it with products, and check on it periodically. People make purchases whether you are there or not. There's still work involved, restocking, maintenance, dealing with the owner of the premises, but the bulk of sales happen without you personally exchanging goods for money. A share of stock in a profitable company works the same way. Once you own it, you can receive a dividend when the company earns profits, without having lifted a finger to produce those profits yourself. The mechanism is identical. The asset earns because it exists and operates, not because you manually labored in that moment. Property income isn't one size fits all. Dividends give you a cut of a company's earnings. Rent comes from letting others use something you own, like an apartment, commercial equipment, or even cloud storage capacity. Royalties and license fees arise when someone is paying to use intellectual property you control, a book, a music track, an image library, a patented process, or a software tool. Equity appreciation happens when an asset becomes more valuable over time, allowing you to profit by selling it later or using it as collateral. In each scenario, the connection is ownership. Without it, the income flow goes to someone else. It's important not to over-romanticize this. While property income can grow without your ongoing labor in the same way wages require it, getting to that point almost always takes capital, initial work, and continued oversight. Even the most hands-off investments demand attention to maintenance, strategic decisions, taxes, and legal compliance. That's why finance professionals often stress that passive income isn't truly passive. It's less time-bound, but it's not zero effort. You might be choosing tenants, reviewing quarterly reports, or updating product versions. These touches keep the asset productive. There's also a financial planning dimension to factor in. Depending on the type, rental income, dividends, royalties, tax treatment differs, and regulations apply. Portfolio income from investments is handled differently by tax authorities than rental income, and royalties may have specific intellectual property rules attached. Understanding these distinctions is critical to keeping more of what you earn and avoiding compliance issues that could erode returns. Why put in that effort? Historically, property income has been the foundation for building and sustaining wealth on a scale wages rarely match. An individual's earning capacity through work has hard limits. Only so many hours in a week, only so much room for raises, only so many job switches before hitting market ceilings. Assets don't share those human constraints. They can compound value year after year, sometimes at accelerating rates, and the income they produce can be reinvested to acquire more assets, creating a cycle wages can't replicate. Over decades, this difference becomes stark. A household relying solely on wages can save and invest, but savings growth depends on surplus after expenses and on raises that may not always arrive. In contrast, a household that begins acquiring assets early benefits from a reinforcing loop. Reinvested dividends purchase more shares, which pay larger dividends. Rental income pays down mortgages faster, increasing equity. Royalties from one product fund development of another. Given enough time, these streams can expand independently of any change in the household's working hours. While a vending machine illustrates the concept in a tactile way, today's most scalable forms of property income are often digital. An app on a platform store can collect downloads and subscription fees globally without you logging in each day. Licensed software might be embedded in multiple other products, creating income from each use. A content archive can generate steady micropayments from views or streams across regions and time zones. The digital nature removes many logistical limits, allowing one asset to serve thousands or millions of users simultaneously. One structural reason property income can outpace wages is how each responds to inflation and productivity gains. Wages, in theory, keep up with inflation. In practice, they often lag, especially during periods of rapid technological change. Assets can appreciate faster than inflation if they are scarce, deliver essential services, or tap into expanding markets. A centrally located rental unit in a growing city can command higher rents as demand rises. Shares in a company that scales globally, especially one deploying technology, can see profits and dividends grow far beyond domestic inflation rates. And royalties for digital products benefit from near-zero distribution costs, keeping margins high. Diversification itself offers value. If your wages take a hit due to automation, a shift in company strategy, or a sector-wide downturn, asset-generated income can act as a financial buffer. It's not dependent on a single employer's decisions or on your ability to land another role. Its performance is tied to the quality and relevance of what you own, which may be shielded from the same risks your labor faces. That independence can make the difference between weathering a disruption and being forced into reactive career changes. Starting, of course, is the hard part. A rental property might be thousands of dollars, even just for a down payment. A share purchase can be made for far less, but still requires setting aside money you might have otherwise spent. The threshold has lowered thanks to technology and financial innovation, but acquiring that first income-producing asset still requires a deliberate shift from pure consumption toward ownership. Those who act earlier benefit from time. the longer the income stream and its underlying asset have to grow, the more powerful compounding becomes. Once you have a working source of property income, your perspective starts to change. You stop thinking in terms of what job can generate this income, and start asking, what can I acquire or create that will make this income for me? The work you choose to do becomes less about filling every available hour for wages and more about building strategic ownership. Over years, that's often the divide between people locked to the ups and downs of salary negotiations and those whose net worth grows even during periods when they personally work less. Data on long-term income distribution underscores the point. During periods of rising productivity but stagnant wage growth, the share of national income going to property increases. The more work machines and systems do, the more production value flows to owners of those means of production, whether they're corporations, funds, or individuals. In today's context, with AI expanding productive capacity while reducing the need for parallel human employment, ownership isn't just a wealth-building strategy. It's an access point to the portion of economic growth still flowing upward. The evidence in favor of property income is clear across history and present markets. The open question is not its potential, but your participation. Without some stake in the assets generating tomorrow's returns, you're confined to the segment of the economy under the most consistent pressure. And with technology making production run around the clock, the closest you can get to matching that output as an individual is to put capital, ideas, or rights into something that will also work continuously. Which leads naturally to a practical problem. Acquiring those kinds of assets used to mean having large amounts of money, connections, or both. That barrier kept many people from reaching the point where income could build without their constant labor. Today, that gate is shifting, and for the first time, access to certain productive assets no longer carries the same financial threshold it once did. Technology that makes ownership accessible. In the past, gaining a stake in a productive asset, whether that was an apartment building generating rent, equity in a profitable company, or part of an infrastructure project, meant significant capital and insider access. Large blocks of ownership were typically reserved for institutions and already wealthy investors. For most people, ownership meant a home mortgage or a retirement account tied to public markets. That pattern held for generations. Now, advances in platform and financial technology allow fractional ownership at a scale, and with processes that make it possible to participate at far smaller amounts. Using secure digital registries and integrated payment systems, as in models mapped by researchers like Dave Shapiro, a project's ownership can be split into precise units, recorded, traded, and tracked without manual intervention. Dividend or rent payments tied to those units can flow directly to each owner's account through automated banking integrations or platform wallets. This combination of distributed ownership and automated custody replaces the cumbersome paper chains and human processing that once made dividing assets into small pieces impractical. Fractional ownership is exactly what it sounds like. You can buy a share small enough to match your available budget and still receive a proportional stream of income from it. A $5 million property can be divided into thousands of units, each tied to a recorded fraction of the total. If you hold 10 of those units, you collect 10 times the income of someone who holds one. The same structure already covers farmland, commercial equipment, private company stakes, and more recently, revenue rights to digital products or curated datasets. A familiar example is a community-owned solar installation. Instead of a single investor funding a field of panels, a cooperative offers shares to local households. Electricity sold into the grid is metered, revenue is collected, and using platform tools distributed directly to those households in proportion to their shares. Participants don't need to apply for permits, climb onto rooftops, or handle repairs. The same principle applies in fractional real estate, where you can buy part of an income-producing building in another city and receive your share of net rent without ever managing a tenant. Platforms behind these arrangements handle the paperwork, resolve ownership transfers, manage the asset's operations, and split income automatically. You log in, verify your identity, choose from a list of available offerings, and fund the purchase. Income calculations and distributions run in the background via the same digital infrastructure that already moves money between banks or settles securities trades. In practical terms, that automation removes the transaction costs and delays that historically limited such deals to large, infrequent investors. Because this can now be done at low cost per participant, the entry point for becoming an owner has dropped sharply. The core structure, spreading risk across multiple assets and collecting steady but smaller streams from each, is no longer the exclusive model of high capital investment firms. It's accessible to people funding their stake from wages or modest savings, applied one fraction at a time. Visibility is another shift. Previously, locating and qualifying for these opportunities relied on professional networks or specialized brokers. Today's regulated platforms list them openly, complete with standardized contracts, projected return bands, risk assessments, and performance updates delivered on schedule. Many offer secondary marketplaces for reselling your stake if you want to exit early, though, as researchers caution, these trades can be less liquid than public markets. Technology also eliminates geography as a constraint. Holding small positions in different sectors and regions, a portion of a warehouse lease overseas, shares in a wind project on another continent, part ownership of a recurring revenue software product, can be done from the same account. Cash flow from each appears separately in your records but lands in one balance. If one asset sees a lean quarter, another might be running at a seasonal peak, smoothing aggregate returns. This degree of diversification used to require an institutional manager and substantial capital. Now it's structurally possible for individuals. None of this removes the need for diligence. You still commit real capital, and you're exposed to asset-specific risks. Values can fall, revenue can miss projections, or tenants can fail to pay. There are also legal, regulatory, and liquidity differences compared to whole asset ownership. Some platforms may hold the title through a custodian entity, adding a layer of platform risk alongside asset risk. And fractional stakes are sometimes harder to sell quickly, especially outside the most active offerings or without a robust internal market. For a participant, that means assessing both the asset fundamentals and the trustworthiness of the platform itself. On the asset side, these systems also offer efficiency. Large project owners prefer a single platform to interface with, rather than managing hundreds of small investors individually. The platform becomes the conduit, allocating income to participants and handling records, while the owner focuses on running the project. If the asset expands, a solar farm doubling its panel count, a warehouse adding new tenants, the platform updates ownership percentages and recalculates payouts without re-engineering the administrative side. This isn't a pilot stage idea. In 2025, operational platforms in multiple jurisdictions are already supporting regulated fractional sales of physical and digital assets. Some integrate directly with banking systems, allowing real-time income transfers. Others use distributed ledger technology to verify and log every change in ownership, making records tamper-resistant and auditable at any stage. The combination of regulation and automation has moved these models from niche experiments to viable channels for building an income base outside wages. For an individual, this changes the timeline of entry. You don't need to wait until you have a windfall or decades of career savings to capture property income. Buying a fraction of an asset, watching its performance, and reinvesting payouts into further fractions creates a compounding effect on a scale that was functionally unavailable to most people even a decade ago. Instead of aiming to replace wage income immediately, the objective becomes securing a second stream that grows regardless of whether wages keep pace. It also reframes what it means to be an owner. The technical execution, issuing ownership units, collecting revenue, and dispersing payouts, is handled by the platform. Your role is to evaluate options, monitor returns, and decide where to allocate additional resources. Over time, you build familiarity with different asset types, risk profiles, and income patterns. That learning deepens your capacity to select opportunities in your own interest, rather than defaulting to whatever your employer or local economy offers. As wages in certain sectors face downward pressure from automation and AI, and the proportion of GDP paid out as labor income shrinks, these lower barriers to asset participation create a path to tap into capital income at smaller scales. The mechanics are accessible from a phone or laptop, removing both geographic and financial distance between you and the productive economy. The rapid adoption of these systems raises a new question that goes beyond individual benefit. They don't exist in a vacuum. They require asset owners willing to carve projects into smaller pieces and sell them to a distributed pool of participants. That invites the next challenge, understanding why major companies or large project owners, who could, in theory, keep all the return for themselves, would choose to open their books to a broad base of everyday investors. The answer speaks to economic self-preservation as much as to generosity, and it's already influencing how some sectors are structuring deals in 2025. Why big business is quietly on board with this shift. For large companies, the decision to offer pieces of ownership to ordinary consumers may seem counterintuitive. but in reality, it can be a calculated way to protect their own markets. The traditional corporate approach has been to keep profits flowing primarily to existing shareholders, the people and institutions with capital already in the game. Yet in many sectors, executives are now facing a basic economic reality backed by decades of demand-side research. When enough households lose disposable income, sales eventually fall, no matter how efficient the business becomes or how compelling the product is. This isn't a shift toward generosity. It's a pragmatic response to the pressure on wages that automation and AI are exerting across industries. If fewer people have surplus income, fewer people can buy. You don't need an advanced economic model to understand that a premium device, subscription, or service line will struggle in a market where buyers can't meet the asking price. Marketing can influence preference, but it cannot close a gap between what something costs and what consumers can reasonably pay. Companies with strong data capabilities don't just track their own sales, they monitor the wider patterns in household spending, credit use, and income distribution. They see their own automation initiatives reducing costs, but also recognize that the same process reduces wages in their customer base. Push this far enough, and the customer pool shrinks to a smaller, wealthier minority. That is not a sustainable demand curve for most business models. In that context, experiments in spreading a small slice of ownership to consumers start to make economic sense. The underlying logic is straightforward. By giving customers a modest but direct stake in the value a company creates, you put some extra income in their hands without committing to fixed wage increases. That extra capacity to spend often circles back into the company's revenue stream. These arrangements look different depending on the sector. Some companies are trialing patron equity schemes, similar to member ownership in established co-ops, where customers who meet certain purchase thresholds earn small annual dividends or credits derived from net profits. Others are exploring local or community investment structures, such as offering fractional stakes in a new retail location to nearby residents, with returns funded by sales performance. In each case, the payment is tied to ownership outcomes, not a static paycheck, which gives companies more flexibility in adjusting distributions over time. Think about the mechanics. In a cooperative outdoor gear retailer, members receive a percentage of annual surplus in proportion to their purchases, a model that keeps them engaged year after year. In a community land trust, residents collectively hold title to property and share in long-term gains, aligning local support with development needs. Businesses applying these templates on a smaller scale to their own operations aren't doing it to redistribute wealth for its own sake. They're testing whether these shared benefit models can keep enough money circulating among their customers to preserve demand. The benefits for companies go beyond just maintaining sales. Sharing even fractional ownership can strengthen brand loyalty, increase retention, and reduce churn. A consumer who receives an annual distribution, however modest, has a tangible reason to remain an active customer. That small payout can offset part of a recurring expense or renew the psychological connection between the consumer's well-being and the company's performance. From a strategist's point of view, this can be more cost-effective than spending the same amount on advertising or short-term promotional discounts. But there's also a reason this isn't suddenly visible everywhere. Implementing these ownership-linked systems is complex. Legal frameworks vary by jurisdiction, securities regulations impose strict requirements, and accounting systems have to reliably track and distribute payouts to potentially thousands of micro-stakeholders. For many firms, this level of operational change demands careful piloting. That's why you're more likely to see these ideas appear in limited regional programs, specific product lines, or through partner platforms, rather than as blanket company-wide policies. Platform-based infrastructure has lowered some of the barriers, but it hasn't removed them. Whether it's regulatory approvals for public offerings, compliance with financial disclosure rules, or navigating the tax treatment for recipients, there are hurdles that make national rollouts slow. Savvier companies observe early movers in smaller markets first, gathering evidence on cost-benefit ratios before expanding. The model elements exist: co-op style dividends, community investment trusts, profit-sharing memberships, but integrating them into a major corporation structure takes time. Regulation, in some cases, is also pushing ownership out to a broader base. Infrastructure projects in certain regions already face mandates to reserve a portion of equity for local stakeholders. What starts as compliance can turn into a strategic advantage when those local stakeholders advocate for the project or become repeat customers. Businesses that learn to align with these requirements can achieve both smoother operations and a modest injection of cash into the communities that sustain their revenues. Developers in urban areas with housing shortages, for example, are finding that offering small equity positions to local residents can lower resistance to new projects. The developer still profits through sales or rents, while residents gain a minor stake in the value being created around them. For the developer, that local buy-in can reduce costly delays. For the residents, it's a foot in the door to asset income in markets they can't otherwise afford. It's not a large-scale redistribution, but it's a signal that aligning incentives can move stalled initiatives forward. Technological efficiency also plays a role in why some companies can attempt this without jeopardizing margins. As automation reduces operating costs, firms have more room in their budgets to fund these limited ownership distributions while maintaining profitability. Allocating part of those savings toward demand sustainability measures is, for some, more attractive than banking it all or competing solely on price cuts. Done right, these programs can be framed internally as growth investments. That's why it would be a mistake to interpret these moves as a wholesale shift in corporate philosophy. The core driver is still self-interest grounded in the economics of aggregate demand. If too much of the value pool concentrates in a small ownership class, the total market for goods and services contracts. In many business models, the risk of that contraction outweighs the marginal cost of sharing a small portion of returns with a broader audience. Early evidence from test runs, though limited, is telling. Consumer groups with a direct stake tend to maintain purchasing levels, exhibit more brand loyalty, and in some cases, refer others into the ecosystem. Those network effects amplify the financial benefits of the initial distribution. While the scale is still small, the underlying principle is attracting interest in boardrooms not known for radical change. For individuals, the significance is twofold. First, these experiments point to additional pathways for participating in asset-based income, even without full direct ownership. Second, they highlight the benefit of staying alert to pilot programs and regional initiatives long before they become mainstream. Waiting for a company-wide rollout means missing the early and often most accessible entry points. The pace and scope of adoption will vary, and most firms will move cautiously. But the fact that such programs are appearing at all, in a corporate culture historically focused on keeping returns tightly held, is itself a sign of how economic pressures are shifting the calculus. They are not cures for wage decline, but they can be tools for partially offsetting its impact in ways that align with corporate incentives. As more of these small-scale ownership avenues emerge, a separate but related pattern is becoming visible. Households are beginning to blend together multiple minor income sources. While each one may be modest on its own, their combined effect can change the stability and resilience of a family's budget. The mechanics of building that kind of income mix are different from relying on a single paycheck, and understanding them starts with examining how these pieces can stack to support everyday life. From one paycheck to many micro-incomes. For most of the last century, the way households earned a living was simple. One person, sometimes two, brought in a paycheck from a single employer. That check covered bills, built savings, and if there was anything left over, paid for extras. Career progress meant climbing the ladder to get bigger checks from that same source. Stability came from tenure, stay in your role, perform consistently, and you could expect to remain on payroll. Even if you changed employers now and then, the structure of your income didn't change much. One job was still the main income source, with everything riding on it. That model relied on wages holding a steady share of economic growth and job security being relatively predictable. In 2025, with automation reshaping production across industries, relying on a single employer to cover your full living costs is far riskier. If that one paycheck stops, most or all of your income stops with it. In some fields, finding a comparable role can take months, and when offers do come, the pay is often lower. These conditions are driving more people to think in terms of constructing an income stack, a blend of multiple small flows that add up over time. An income stack works by combining several modest revenue streams into something more resilient than one large wage source. Instead of one large pipe filling your income tank, think of a series of smaller ones doing it together. If one slows or stops, the others keep money coming in. It's about redundancy, not excess, having safeguards so no single interruption wipes out all cash flow. The streams can look very different, but property income often forms the foundation because it isn't tied to constant labor. One person's mix might include quarterly dividend payments from stocks, monthly distributions from a fractional real estate investment, small but steady royalties from a design file licensed years ago, occasional payouts from a cooperative membership, interest from vetted peer-to-peer loans, and revenue from licensing images through an online marketplace. Taken individually, none of these would pay the bills. Combined, they form a baseline before any wages or contracts are even counted. For instance, imagine 8 small streams. $80 a month from dividends, $120 from a share of a rental property in another city, $50 from a renewable energy co-op, $90 in music royalties, $70 from online content micropayments, $60 interest from lending, $50 from leasing unused server capacity, and $40 from renting out equipment through a local app. Together, that's $560 each month. It might not replace a salary, but it reduces the financial shock if wages drop. That steady floor can buy time to look for new work or reshuffle priorities without sliding directly into crisis. The psychological effect can be as important as the money. If all your income hinges on one employer's decision, you have little leverage. With other income arriving regardless of job status, you can make more considered career moves. In an unstable labor market, that ability to choose, rather than react, changes the dynamic. A diversified stack gives you options in a way a single paycheck cannot. Stacks also have room to grow. A modest stream can expand as you reinvest what it produces, or as the underlying asset becomes more valuable. Dividends can purchase more shares and boost future dividend totals. Rental income from one fractional property can fund the purchase of another, widening your holdings. Starting small is not the same as staying small. The structure lets you layer on more streams as you find them. Technology now makes managing this mix easier than it has ever been. What once required multiple accounts, paper trails, and manual record keeping can now be handled in a single dashboard. Payouts arrive automatically, and reinvesting them is often just a matter of clicking a button. This reduced friction is one reason stacking has moved from theory to regular practice for more people. You don't need to be a full-time investor. You need productive assets and a system to coordinate them. Some flows will seem too minor to bother with $20 here, $30 there, until you remember they operate alongside others. What matters is that they arrive on their own schedule, independent of your labor, and often at different points in the month. A $60 quarterly dividend and a $50 monthly co-op payout together can smooth cash flow even if the amounts are modest. A key strength of stacking is its ability to buffer against downturns in one sector. If you draw income from unrelated areas, for example, infrastructure leasing, a solar project, an index fund, and a licensing agreement, they would all have to falter simultaneously for your whole stack to take a large hit. That spread doesn't eliminate risk, but it lowers the odds that one event wipes out your monthly inflow. Building a stack isn't about quitting work. It's about reducing the fragility of your finances. Your main wage source can still be part of the mix, but it sits alongside other flows that help stabilize your position when that wage is under pressure. Guidance from sources like Investopedia and Bankrate frames this approach as realistic, with examples ranging from dividend-paying equities and REITs to selling digital products or media licenses. These are not abstract ideas. They are approaches ordinary investors and creators already use. It is worth noting the need for realistic expectations. Initial payouts from microstreams are often small, and they take time to grow. Financial advisories stress that these streams should be viewed as long-term building blocks, not salary replacements you can create overnight. Diversification and patience matter because any single stream can underperform or end. The aim is resilience through gradual compounding, not sudden independence from wages. The skills needed aren't complicated. They involve spotting opportunities for ownership or participation that match your means. That could be buying into a cooperative, setting aside some earnings for dividend-paying funds, or licensing creative work you already produced. The important part is treating each addition as one piece of a growing framework. Over months and years, more pieces lock together and form a base less vulnerable to shocks. In the older model, financial security came from maximizing one paycheck. In the emerging one, it comes from balancing across multiple streams so no single failure dictates your whole situation. You can lose a co-op payout or see a stock cut its dividend and still have other flows arriving. Many who have built stacks describe them as a kind of insurance, a buffer that lets them adjust rather than collapse when something changes suddenly. The shift from relying on one employer to weaving together many small incomes doesn't happen in a weekend. Each step builds on the previous ones, and each dollar reinvested strengthens the structure. And while it won't immediately replace an active wage, it steadily changes your position from dependent to buffered. This isn't just a strategy for people with large surplus cash. It's a practical adaptation for anyone who wants to capture some of the value being generated outside traditional jobs. The next logical step is to look closely at what this process feels like in practice, how individuals start, which paths they choose, and how those small beginnings can look a few years down the line. What building asset income looks like in real life. One of the clearest ways to understand how asset income works is to look at it through a practical, everyday lens. Imagine a composite scenario based on common patterns from people who have taken first steps into ownership, an average earner, not sitting on an inheritance, who chooses to shift a small portion of unused income into assets that steadily produce returns. In this case, think of someone with a steady day job and modest savings, who is worn down by the hours from a second, lower-paying side job. That second job adds just enough to cover expenses, but the cost is evenings and weekends given over entirely to work. At a certain point, instead of continuing those extra shifts, they take the small cushion built from that side job and begin directing it toward income-producing assets, ones that can quietly add to their budget without requiring more hours. The first step might be opening a brokerage account and buying into a low-cost fund that holds a mix of dividend-paying companies. These funds don't require a huge buy-in. Fractional shares mean someone can contribute whatever small amount they have and still get proportional exposure. The first dividend payouts may be small, but they arrive without any clock-in time. That alone reframes income as something that can flow without showing up for a set shift. Alongside that, they could join a regulated fractional real estate platform. Instead of buying a whole property or taking on a mortgage, they acquire a tiny percentage of a pool of rental units in different cities. Each month or quarter, the platform distributes a share of the collected rent directly to investors' accounts. The amounts from an initial contribution are modest, but again, they arrive independently of active labor. A third layer might come from peer-to-peer lending networks vetted to reduce risk, where individuals collectively fund small business loans or community projects. Returns are paid out periodically and can be reinvested into new loans right on the platform. The key is diversification. Even if one loan falls behind, the other streams keep arriving, and no single setback halts progress. This kind of structure, separate inflows from different asset types operating on different schedules, isn't about instant wealth. It's about converting even small, spare amounts of income and time into own positions that throw off returns. None of these examples involve insider access or advanced financial engineering. They use widely available tools that banks, investment platforms, and fintech companies already offer, often with simple onboarding and automated record keeping. Reinvestment is what makes the shift more than symbolic. When each dividend, rent payout, or interest return is redirected back into growing the underlying asset, the effect compounds. Instead of being spent immediately, the income helps buy a larger position, which in turn earns a proportionally larger payout next time. Over repeated cycles, the increase starts to accelerate, even if top-ups from new cash are minimal. Realistically, progress happens in small increments. The first few months might feel slow, with returns barely noticeable against total expenses. But the point isn't to match a wage on day one. It's to install a base that doesn't go away the moment a side job or main job ends. Even a few permanent streams, however small, change the shape of someone's monthly income. These efforts also free up hours that would otherwise be sold for low-margin labor. Without the burden of a second job to make ends meet, there's space to read, research, and explore other opportunities. That time can lead to finding higher-yielding assets, learning how to use tax-advantaged accounts, or branching into different ownership models altogether. The learning itself feeds the system by helping the person allocate capital more effectively. Setbacks are inevitable. A property fund might post a weaker quarter due to maintenance costs, or a lending platform could have a few borrowers miss payments. But with multiple streams, those dips don't hit the whole portfolio at once. One stream may slow down while another grows, and the net effect remains stable or still climbing. Such resilience is built into the design when income comes from varied sources. The reason this kind of example resonates is that it strips away myths about needing exceptional luck or starting capital. Replacing even a partial side income through owned assets is realistic over time if the approach is disciplined. Select an accessible entry point, commit to reinvestment, and layer on new sources gradually. The longer each stream is in place, the more it contributes to the whole, and the less exposed the household is to a single employer's fortunes. A useful operational tip is to start small, automate dividend or rent reinvestment wherever the platform allows, and manage everything from a consolidated dashboard. Modern financial tools make it possible to see multiple streams in one place, track growth over time, and roll returns straight into more holdings without manual transfers. This reduces the friction that used to make managing diverse assets too time-consuming for most individuals. From there, the pattern repeats. Once the initial holdings are in place and producing, extra savings from a bonus, a tax refund, or a freelance project can be allocated into the same or complementary assets. Over a couple of years, the total monthly inflow from these holdings can grow to a level that noticeably supports the household budget or offsets the need for additional labor hours. The real advantage is that these inflows don't depend on being rehired or renegotiating pay. They keep operating day and night as long as the assets exist. Breaking the dependence on a single paycheck isn't necessarily about replacing it entirely. It's about shifting some of the household's income mixed toward sources that operate independently of a job market under pressure. In an era where wages in some fields are static or falling despite broader economic growth, that independence is a practical layer of security. This doesn't mean ignoring risk. Markets fluctuate, tenants change, companies can cut dividends, and platforms can close. That's why diversity of type, geography, and schedule matters. A healthier mix might combine public market exposure with private or physical assets and shorter-term payouts with long-term appreciation. Over time, the spread helps smooth out the bumps. For someone starting today, the building blocks aren't hypothetical niche experiments. They are products and platforms operating at scale, with enough transparency and infrastructure to allow regular participants in. Using them doesn't require advanced training, but it does require attention to costs, platform reliability, and reinvestment discipline. What stands out is that the earliest and smallest moves often have the highest value in hindsight. Each month that asset income flows in and compounds is one more month tested, one more layer of permanence added. Waiting for the right amount to start often means missing the compounding that could have been building quietly in the background. By viewing the process in a real-world framework rather than abstract theory, it becomes easier to see that asset income isn't reserved for a privileged subset. It is accessible in pieces, built steadily, and protected through diversification. This is what makes it feasible for an average household to begin capturing a share of economic growth outside the wage channel. The challenge now is less about whether this approach works, evidence shows it can, and more about deciding when to begin and where to focus first. That question matters more each year that wage pressure tightens, and the sooner it's answered, the more time those first assets will have to do their quiet work in the background. The first moves to make before 2030. When you decide to shift part of your income toward ownership, the first challenge is knowing exactly where to start. General advice to build asset income can sound abstract or out of reach, as if you need a lump sum in the bank before you can take action. In reality, your most important move is to start with steps that are small, low friction, and easy to repeat. You set the clock running by beginning with what you can do now, not by waiting for some ideal amount of spare cash or perfect market timing. The closer you are to 2030, the more every year matters. Practical first move is opening a simple investment account and directing a small automatic contribution into a broad-based index or dividend-paying ETF. The mechanics are straightforward. Choose a reputable, low-cost platform, open the account, select one fund, and schedule recurring monthly contributions, even a modest amount like $50 or $100. Over time, you're acquiring fractional ownership in a wide range of companies, many of which pay periodic dividends that can be reinvested. The output may be small at first, but it puts you in the ownership column and builds the habit of moving cash from passive storage into assets designed to produce a return. The second step is joining a vetted fractional ownership or community investment platform. This could mean buying a small slice of an income-producing property, a share in a local renewable energy project, or a unit in a co-op-owned commercial asset. Platforms that meet regulatory standards manage the operational side, finding and maintaining the asset, collecting the income, handling legal matters, so participation doesn't require specialist knowledge. You choose an offering, commit an amount you're comfortable with, and begin receiving proportional payouts based on the performance of the underlying project. For many, this is also the first exposure to the cadence of non-wage income arriving on its own schedule. The third move is setting up one micro-income stream that runs with minimal ongoing work. This could be licensing an existing photograph to a stock image library, publishing a design to a print-on-demand store, enrolling a short guide or tutorial on a digital marketplace, or lending through a peer-to-peer platform with automated interest payouts. The goal here isn't to replace your primary income, but to see, firsthand, money arrive without incremental hours of labor. That early proof, even if the first deposits are modest, removes the mental barrier around the concept. From there, repeating the process with new assets or scaling the original is easier. These three entry points align with widely recommended principles from financial guides and investment research. Start broad and low cost, leverage pooled resources, and create at least one process where income accrues without more work hours. They work as parallel efforts. You can open the ETF account this week, register with a fractional platform next week, and list a digital asset within the same month. None require advanced knowledge before you start. The learning happens faster once you're participating. That said, each step carries potential risks and costs. Investment accounts have management fees, platforms can impose transaction costs, and all assets are subject to market fluctuations or operational underperformance. Fractional and community investment platforms depend on third-party management, so there's platform risk. If the operator fails, your access or returns could be disrupted. Any form of investment also has tax implications. Even modest dividends or payouts need to be reported, and their tax treatment can differ depending on the type of asset. Before committing funds, it's worth keeping a basic emergency cash reserve so your day-to-day stability doesn't hinge on the performance of these investments. Consulting basic tax guidance or reputable financial literacy resources can help you avoid compliance issues that chip away at returns. Approaching this with measurable goals strengthens follow-through. Set a 12-month target that's easy to track, such as building at least one active micro-income source and recording every payout it generates. You're aiming to see the number of sources grow, however slightly, and to move from zero to at least some baseline of non-wage income. This visible progress reinforces the habit and makes it clear when you're ready to scale the amounts you commit. Thinking in terms of these measurable steps also reveals the compounding effect. A recurring ETF contribution slowly builds the holding, dividends add to it, fractional investments generate periodic payouts that can be reinvested, and the micro-income stream earns in the background. Each strand is small on its own, but together they steadily shift your total income mix. Over several years, the passive component becomes noticeably more significant, and you've established systems to keep expanding it. It's important to recognize that these early steps are about building a foundation, not achieving instant independence from wages. Your primary income still matters, and it funds much of your asset acquisition. The difference is that you're redirecting a piece of it into things designed to work for you in the future. That future arrives faster than most think, especially when labor markets can change in months rather than years. If you've avoided starting because the amounts feel too small to make a difference, remember that the first goal is to change the structure of where your income comes from. The dollar value matters less than proving you can acquire and benefit from assets. Every distribution, however small, is proof that you've left the single paycheck model behind. Over time, the numbers can scale, but the structural change is what insulates you from being entirely dependent on wages. Even trial and error here delivers value. Choosing an underperforming ETF or a fractional project with weaker returns is part of the learning curve. These outcomes teach you to assess risk, read offering documents carefully, and diversify holdings. When stakes are low, the tuition for these lessons is affordable. By the time you're putting more money in, your decision-making framework is sharper. Accessibility is another advantage. All three suggestions, automated ETF contributions, fractional asset participation, and low-maintenance micro-income, can be started online with standard verification processes. There's no need to change your career, relocate, or wait until you know everything. The earlier they're in place, the more cycles of growth, payout, and reinvestment they can complete before 2030. By framing them as parallel steps rather than a linear progression, you shorten the time to see tangible results. You can reallocate part of your next paycheck into the ETF, sign up and fund a fractional project within days, and publish a licensable digital asset this weekend. At the end of a month, you'll already have multiple moving parts to watch, and that visibility changes how you think about earning. These actions are a starting kit for shifting toward an income mix that is less exposed to wage instability. They don't demand large inputs or perfect timing, and they can be scaled as your comfort and capital grow. What they do require is a choice to begin before external conditions force your hand. The closer we move toward the late 2020s, the more the gap will widen between households with even modest asset income and those without. Your goal between now and the end of this year can be as straightforward as implementing one of these steps in the next 7 days. The sooner you begin, the sooner you can track progress over months instead of wondering when to act. Measurable goals and simple, repeatable actions make it more likely you'll keep at it, which is where the long-term advantage comes from. Taking these first moves while conditions still allow gives you a better chance of maintaining control over part of your future income mix. They prepare you for a time when wages might not be able to keep up, providing a growing floor beneath your finances. And as the decade moves on, the consequences of not having that floor in place will only become more visible. Looking ahead, two paths are possible. Absent major policy changes, the gap between households with assets and those relying only on wages is likely to widen. With deliberate policy and broader access to ownership, that gap can narrow, but it will not close by itself. The direction depends on action taken now, not in a distant decade. Within the next 7 days, open a brokerage account or join one regulated fractional ownership platform and set a small automatic contribution. Start the habit while the amounts are manageable. If you want a short checklist to start your first micro income this week, like and comment OWN, and I'll pin the next post with a step-by-step.